The whispers are growing louder. Economic indicators flicker like warning lights on a dashboard. The question isn't if a recession is coming, but when and how deep. And for millions of homeowners across America, that question carries a terrifying echo. What will happen to my home? While some markets are built on solid bedrock, others are precariously perched, vulnerable to a sharp downturn that could send home values spiraling, costing homeowners tens of thousands or even hundreds of thousands of dollars in lost equity. A recession doesn't just mean job losses and tightened belts. It means a seismic shift in buyer confidence, a freeze in lending, and a harsh reevaluation of inflated prices. Markets that saw explosive, speculative growth during the boom could become ground zero for a devastating collapse, especially those reliant on fickle industries or fueled by investor frenzy. The very pillars that prop them up could crumble overnight. Which cities, the former darlings of the housing boom, are now teetering on the edge, most exposed to the chilling winds of an economic downturn? Where are the fault lines most pronounced, threatening to give way if the U.S. economy takes a dive? We're diving deep into the data, identifying the most fragile markets. Get ready for a sobering truth. Today, Discover the Nation unveils, if the U.S. enters a recession, these 10 housing markets could collapse. If you own a home here or are considering buying, this is your crucial warning.
Number 10. Dallas, Texas. The gleaming heart of North Texas, a symbol of relentless corporate relocations and a seemingly endless economic boom. Dallas has been a magnet for population growth and real estate investment. But in 2025, if the U.S. economy enters a recession, Dallas's housing market could prove surprisingly vulnerable, threatening to wipe out recent gains for many homeowners. Dallas's explosive growth was fueled by massive corporate influx, a booming tech sector, and a reputation for endless opportunity. This led to rapid price appreciation, often 60 to 80% since 2020, that while impressive, far outpaced local wage growth and created significant overvaluation in certain segments. Developers responded by building furiously, particularly in the northern suburbs, leading to a substantial oversupply in the wider metro area. If a recession hits, corporate expansions would halt, jobs in tech and financial services could be impacted, and the flow of high-earning relocations would dry up. This would quickly erode buyer demand, especially with mortgage rates hovering at 7%. The evidence suggests vulnerability. Inventory has already surged across Dallas and its suburbs, up 45% year over year, and homes are sitting longer, average 75 days. Price cuts are becoming common. In a recession, this trend would accelerate dramatically. Job losses would directly impact affordability, pushing more homeowners into financial distress. Furthermore, Dallas saw significant investor activity. In an economic downturn, these investors might panic sell, flooding the market with even more listings. Dallas's sheer size and growth make it seem robust, but its rapid appreciation and substantial new inventory create fault lines that could lead to a painful collapse if a recession materializes, threatening a significant loss of equity for those who bought at the peak. Number 9. Tampa, Florida. This vibrant, sun-drenched city on Florida's Gulf Coast became one of the nation's hottest destinations, drawing unprecedented migration and investment. Its radiant sunshine seemed to promise immunity from economic woes. But in 2025, if the U.S. economy enters a recession, Tampa's housing market could face a severe downturn, with values potentially falling by 15 to 20% as its core drivers falter. Tampa's explosive growth was fueled by its booming tourism and hospitality sectors, a continuous influx of new residents, and an appealing lifestyle. Builders responded by pouring concrete for homes and condos at a furious pace. However, a national recession would directly impact these pillars. Discretionary spending cuts would cripple the tourism industry, leading to widespread job losses in hospitality and related service sectors. Reduced consumer confidence would also slow the pace of in-migration, diminishing buyer demand. If you're finding this deep dive into housing trends crucial for your financial understanding, please gently hit that subscribe button to Discover the Nation. It helps us bring you more vital insights like this. The danger for Tampa is compounded by Florida's escalating and crippling property insurance crisis, which already adds thousands to homeownership costs. In a deep recession, this burden would become unbearable for many, triggering defaults. The sheer volume of new inventory built during the boom would sit empty as demand for homes, including investment properties, plummets. Mortgage rates at 7% would make purchases even more untenable. Tampa's market, built on a foundation of tourism and rapid growth, is highly susceptible to cuts in discretionary spending and a general economic slowdown, potentially triggering widespread price corrections and significant equity losses.
Number 8. Denver, Colorado. The mile-high city, renowned for its breathtaking mountain views, vibrant outdoor culture, and booming tech scene, became a magnet for remote workers and young professionals. Its housing market soared, reflecting its immense desirability. But in 2025, if the U.S. enters a recession, Denver's elevated housing market could face a sharp and painful collapse, proving that even a highly desirable location isn't immune to economic gravity. Denver's growth was driven by its thriving tech industry, outdoor lifestyle appeal, and a continuous influx of high-earning residents. This combination led to substantial price appreciation, over 50% since 2020, making it one of the most expensive markets in the interior U.S. However, a national recession would directly impact Denver's tech sector, leading to significant layoffs and hiring freezes, as seen in previous economic downturns. This would drastically curtail the influx of buyers and erode the purchasing power of existing residents. The danger for Denver lies in its already stretched affordability and the prevalence of a buyer pool with high debt-to-income ratios. With current 7% mortgage rates, affordability is already a critical concern. Job losses in a recession would immediately put immense pressure on homeowners, potentially forcing increased inventory as residents can no longer afford payments. Inventory has already surged, up 38% year over year, and homes are sitting longer, average 75 days. In a recession, this surplus would overwhelm demand, leading to widespread price reductions. Denver's housing market, built on a foundation of high salaries and continuous growth, is particularly vulnerable to job cuts and reduced consumer confidence. A recession could trigger a significant repricing, threatening substantial equity losses for those who bought into the mile-high city at its peak. Number 7. Seattle, Washington. The rain-kissed tech giant of the Pacific Northwest, where colossal corporations like Amazon and Microsoft built empires of wealth, propelling housing prices to dizzying heights. But in 2025, if the U.S. economy enters a recession, Seattle's tech-dependent housing market could see home values fall by a painful 15 to 20%, proving that even robust tech hubs are vulnerable to broader economic winds. Seattle's housing boom was inextricably linked to its thriving tech sector, attracting a continuous influx of high-earning professionals. This created immense demand and drove prices to astronomical levels. However, a national recession would inevitably lead to significant layoffs, hiring freezes, and reduced expansion within the tech industry, directly impacting Seattle's primary buyer pool. The already high cost of living here, coupled with 7% mortgage rates, means that even a modest downturn in employment would swiftly make homeownership unsustainable for many. The danger for Seattle lies in its concentrated economic base and elevated price points. Inventory, while not seeing the explosive surge of some sunbelt cities, has already increased by 25% year over year. In a recession scenario, this supply would overwhelm reduced buyer demand, leading to widespread price cuts. Furthermore, the reliance on high salaries for affordability means that any job insecurity would quickly translate into homeowners reevaluating their ability to meet high monthly payments. Seattle's market, built on a foundation of seemingly endless tech growth, is particularly susceptible to a slowdown in that sector, threatening substantial equity losses and a sharp correction if a recession materializes.
Number 6. San Francisco, California. The iconic city of innovation, extreme wealth, and unparalleled real estate values, San Francisco has long defied gravity. But in 2025, If the U.S. economy enters a recession, this city's housing market could face a truly devastating collapse, with home values potentially plummeting by 20 to 25%, making it one of the most vulnerable in the nation. San Francisco's stratospheric housing market was fueled by the hypergrowth of the tech industry, venture capital infusions, and a relentless demand for limited urban space. This led to prices reaching the absolute highest in the nation. However, a national recession would hit the tech sector hard, leading to widespread layoffs across startups and established giants alike. This would directly impact San Francisco's core buyer demographic, causing demand to evaporate for its already astronomically priced properties. The risk for San Francisco is magnified by its extreme unaffordability, the ongoing outmigration, even before a recession due to high costs and quality of life issues, and the sheer concentration of wealth tied to the volatile tech industry. With current 7% mortgage rates already making ownership impossible for most, a recession-induced job market contraction would trigger widespread defaults and force sales, leading to a flood of inventory. Furthermore, San Francisco saw significant investor presence, and in a downturn, these investors would likely pull back or liquidate assets rapidly, accelerating the price collapse. The city that epitomizes tech boom excess is uniquely positioned for a brutal bust if a recession takes hold. Number 5. Miami, Florida. This glittering, iconic global city, a magnet for luxury tourism, international investment, and vibrant culture, experienced an unparalleled housing boom in recent years. Its radiant sunshine seemed to promise immunity from economic woes. But in 2025, if the U.S. economy enters a recession, Miami's housing market could face a severe and painful collapse, with values potentially falling by 18 to 22% as its core drivers falter. Miami's explosive growth was fueled by its booming tourism and hospitality sectors, a continuous influx of international capital seeking safe haven, and an appealing lifestyle. Builders responded by pouring concrete for luxury condos and high-end homes at a furious pace. However, a national recession would directly impact these pillars. Discretionary spending cuts would cripple the tourism industry, leading to widespread job losses in hospitality. International investment, often sensitive to global economic uncertainty, could rapidly retreat. The danger for Miami is compounded by Florida's escalating and crippling property insurance crisis, which already adds thousands to home ownership costs. In a recession, this burden would become unbearable for many. The sheer volume of new luxury inventory built during the boom would sit empty as demand for high-end second homes or investment properties plummets. Mortgage rates at 7% would make luxury purchases untenable for most buyers. Miami's market, built on a foundation of tourism and external investment, is highly sensitive to cuts in discretionary spending and global capital flows. A recession would expose its speculative excesses, triggering widespread price corrections and significant equity losses.
Number 4. Boise, Idaho. This picturesque city, nestled in the Treasure Valley, became the undisputed poster child for the pandemic-era housing boom, drawing an unprecedented influx of remote workers seeking affordability and a high quality of life. Home prices here skyrocketed, and builders responded with a frenzy of new construction. But in 2025, if the U.S. economy enters a recession, Boise's housing market could face a truly monumental collapse, with values plummeting by 25 to 30%, making it one of the most susceptible in the nation. Boise's explosive growth was almost entirely fueled by external migration, primarily tech workers fleeing more expensive coastal cities, drawn by its then relative affordability. Developers capitalized on this by initiating massive new subdivisions. However, a national recession would accelerate the ongoing shift in remote work policies, trigger widespread tech layoffs, and drastically slow down or even reverse that vital in-migration. Boise's underlying local economy is less diversified than larger metros, making it vulnerable to absorbing significant job losses if its primary growth driver falters. The danger for Boise lies in its extreme overvaluation from the boom and its heavy reliance on a now uncertain external buyer pool. With current 7% mortgage rates already making prices challenging, a recession would quickly put immense pressure on homeowners. New home inventory has already exploded by over 50% year over year.
In a recession, this massive surplus would overwhelm drastically reduced demand, leading to widespread price reductions. Boise's market, built on the foundation of rapid in-migration and speculative growth, is uniquely exposed to job insecurity and a reversal of lifestyle trends, threatening severe equity losses for those who bought at the peak. Number 3. Las Vegas, Nevada. The shimmering oasis in the desert, built on glitz, glamour, and an ever-present dream of quick riches, experienced an unparalleled housing boom. Its fortunes have always been intertwined with tourism and hospitality. But in 2025, if the U.S. economy enters a recession, Las Vegas's housing market could face a truly monumental collapse, with values plummeting by 25 to 30%, making it one of the most volatile and exposed in the country. Las Vegas's housing market is highly susceptible to boom and bust cycles, fueled by tourism, hospitality, and significant real estate speculation. A national recession would directly cripple the tourism and convention industries, leading to massive job losses for the city's vast service workforce. Discretionary spending cuts would empty hotel rooms and casinos, sending ripple effects throughout the local economy. This direct impact on employment would swiftly translate into widespread foreclosures and distressed sales, overwhelming the market. The danger for Las Vegas is compounded by its history of extreme volatility and a high presence of real estate investors. Many investors bought properties here for short-term rentals or flips. In a recession, as tourist numbers drop and cash flow turns negative, these investors would likely panic sell, flooding the market with listings and accelerating a price collapse. New home inventory has already surged dramatically, up 60% year over year. In a recession, this vast supply, combined with dwindling demand, would lead to aggressive price cuts. Las Vegas's market, built on the fragile foundations of discretionary spending and speculative investment, is uniquely exposed to an economic downturn, threatening a devastating loss of equity for countless homeowners.
Number 2. Phoenix, Arizona. Once, without a doubt, one of the absolute hottest real estate markets in all of America, this desert metropolis became a magnet for sun seekers, remote workers, and aggressive real estate investors. Builders, in turn, unleashed a relentless torrent of new construction across the sprawling valley. But in 2025, if the U.S. economy enters a recession, Phoenix is poised for a monumental reckoning, with home values potentially collapsing by 25 to 30%, making it one of the most vulnerable markets in the nation. Phoenix's explosive growth was fueled by unparalleled in-migration, the allure of warmer weather, and a seemingly endless appetite for new homes and investment properties. However, a national recession would directly impact this growth. Job losses in sensitive sectors, like tech, would curtail migration. More importantly, high interest rates, coupled with an economic downturn, would trigger a massive pullback from out-of-state investors who heavily drove the market, leading to widespread liquidation of assets. The danger for Phoenix is magnified by its extreme oversupply of new construction, inventory up 60% year over year, and its prior speculative frenzy. In a recession, this vast new inventory, combined with a sharp drop in overall demand, would lead to widespread price reductions, accelerated builder incentives, and an increase in foreclosures. Rising concerns about the region's long-term water supply could also intensify during a period of economic uncertainty, adding another layer of risk perception. Phoenix's market, built on a foundation of rapid growth and speculative investment, is uniquely exposed to an economic downturn, threatening severe equity losses and a prolonged recovery.
Number 1. Austin, Texas. Topping our list as the U.S. city most vulnerable to a housing market collapse if a recession hits in 2025 is Austin, Texas. The Silicon Hills of the South, a city synonymous with hypergrowth, tech innovation, and a seemingly endless influx of new residents. Austin was, without question, America's hottest real estate market for years, driving property values to dizzying, unsustainable heights. But in 2025, if the U.S. economy enters a recession, that feverish expansion could turn into an equally brutal contraction, leading to a monumental collapse, with home values potentially plummeting by 30% to 35% or even more. Austin's unprecedented boom was the poster child of pandemic-era remote worker migration and massive tech corporate expansions. Developers, eager to cash in on what seemed like limitless demand, initiated an almost unimaginable pace of new construction, from high-rise condos downtown to sprawling master-planned communities in every direction. They built at a furious, speculative pace, pushing tens of thousands of new units onto the market. However, a national recession would bring with it major tech layoffs. Meta, Amazon, Tesla, etc. already seen some. A recession would accelerate, a widespread pullback of remote work mandates, and a general freezing of corporate investment. This would cause buyer demand to fall off a cliff, leaving an astonishing surplus of both new and existing homes. The danger for Austin is magnified by its extreme overvaluation from the boom, its immense overbuilding, new home inventory already up 70% year over year, and its heavy reliance on high-earning tech migrants. In a recession, this vast oversupply, combined with dwindling demand, would lead to unprecedented aggressive price reductions across the board. High property taxes, often exceeding $8,000 annually, would further burden homeowners facing job insecurity or reduced income. Austin's market, built on a foundation of speculative tech growth and a constant flow of new residents, is uniquely exposed to a severe economic downturn. If a recession truly takes hold, Austin's housing market could prove to be the ultimate cautionary tale, facing a devastating loss of equity and a prolonged recovery.
Final thoughts. This has been a stark, sobering look at the 2025 U.S. housing market, exposing the immense vulnerabilities facing some of the nation's fastest-growing cities if a recession takes hold. The ambition of builders, fueled by years of unprecedented demand, has collided head-on with economic realities, high interest rates, and a recalibration of migration patterns. The consequences are profound. For developers, it's a lesson in over-speculation, leading to financial pressure and desperate measures. For local economies, it signals a slowdown in a key sector, potentially leading to job losses and reduced consumer confidence. And for millions of homeowners in these exposed markets, it highlights a crucial risk. The very asset they've invested in could see significant value erosion, impacting their financial security for years to come. What's next for these vulnerable markets? Only time will tell if a recession will truly test their foundations, or if they can find a way to adapt. For now, the warning signs are clear, and vigilance is paramount. This has been Discover the Nation,